Econ 101. Did you take that in college? Economics 101. It's amazing how many people who maybe even took that course in college forget that it's far better to raise the revenue that's being taxed in America, let's say, than just raising taxes. It's amazing how many politicians forget this principle, or maybe they never learned it. In this episode, I'm going to talk about the concept that if you want to stimulate the economy, create jobs, lower unemployment, and actually raise tax revenue, it's usually far more effective to raise the revenue that's being taxed than just raise taxes. And I'll prove it to you, and I'll show you how this has come into play in American history many, many times. Get ready. So I'm Doug Andrew. I've been a financial strategist and retirement planning specialist now for 5 decades, helping thousands of Americans optimize their assets, minimize taxes, and empower their authentic wealth. And back in the day when I attended college, I took my economics classes, and I remember Econ 101 talking about these concepts. And it's amazing to me how many politicians, they've never run a business or a candy store before, and so they don't understand basic economics. So let me explain why it's far better to raise the revenue that's being taxed in a country than just raising taxes if you need tax revenue, okay? So we see this happening when we usually have crashes in the market. We have 9/11 terrorist attacks. We have the 2008 mortgage meltdown. We have the COVID-19 pandemic. Most of the time, both Republicans and Democrats will not raise taxes when the economy is sluggish. But it seems like every time the economy starts to grow, they want to spend more and they want to raise taxes. And then they wonder why we go through cyclical recessions. So you'll notice that when they want to stimulate the economy and actually raise tax revenue, the smart ones who have run businesses before, because the government is really like running a business, even though a lot of times politicians don't totally run it very well. So let me go through and explain how this works, because after the 9/11 terrorist attacks, we actually lowered taxes, and the amount of tax revenue that came in was greater than if they had raised taxes, and that would have caused an elongated recession. Same thing happened after 2008. Well, let's move to Donald Trump. Donald Trump was a businessman, and he understood how money works. And so in 2017, he passed the Tax Cuts and Jobs Act in 2017. And this actually lowered tax rates for the lowest that it had been in years. The ensuing years, 2018 and 19, the actual tax revenue the federal government experienced was greater than if they had raised taxes, and he created tons of jobs in the process. Now, just think about this economically. When you lower taxes, that infuses the economy with more money. And so they hire people, they expand their corporations, they invest in innovation and automation, all kinds of things, okay? And this is what stimulated the economy. And so the revenue in America went up. And the taxes, even though they were a lower rate, the lower tax rates on a bigger amount of revenue generated more tax revenue than if they had raised taxes. And it's amazing how many politicians do not understand this, and they're so anxious to raise taxes and have all of these different things, and then they wonder why we head into another recession. So what's going to happen here is that when we lower taxes and it brings about a great economy, well, then COVID-19 came in. And thank goodness we had low taxes. And you notice the government didn't want to touch taxes during that low period. But when things start to turn around, they immediately want to start spending more money because they've been spending far more than what they brought in. During COVID-19, they spent triple what they brought in. Now, if you and I, we're making $100,000 and we spent $300,000 by borrowing the deficit of $200,000. Something has to give. We have to file bankruptcy, or we have to go out and get a second or third job, or what have you. We have to tighten our belt. The government doesn't do that. They print more money, that causes inflation, which is a hidden tax, and they eventually plan to raise taxes. Okay, so if Congress does nothing at the end of a tax cut, most tax cuts have an expiration date or a sunset date. And so the 2017 Act will sunset at the end of 2025. And so what does that mean? The 12% tax bracket moves to 15. Okay. The 22 moves back up to 25. The 24 moves to 28. The 32 moves to 33. The 37 moves to 39. Okay. And President Joe Biden has wanted to raise the tax rates even higher than this. But if Congress does nothing, the tax increase will be one of the greatest increases this country has seen after having a low tax rate in all of these brackets since the year 2017 up until 2025. Well, let me just show you how many politicians don't get it. Let's just pick this one right here. A lot of Americans are in a 24% federal tax bracket, or maybe 22%. So when the politicians say, well, the 24 is going to move to 28. That's only 4% more. Well, not really, okay? If you begin paying $28 on every $100 of taxable income, and you used to pay $24, that's $4 more. $4 represents a 16.66% increase in money that you're shelling out in tax. Yeah, it's another 4%, but it's 16.66% more money because of the $28 compared to the 24. That's $4 more. You divide 4 into 24, that's 16%, okay? And a lot of people don't understand that, and politicians wonder why people go, I can't afford this. Now, what does this mean? It means that there's opportunities, and I'm going to show you a single taxpayer and also a married taxpayer filing a joint tax return. In the year 2024, for example, when this is being recorded, if we have a single taxpayer between $47,000 and $100,000 of taxable income, you have $53,000 of room where you will pay only 22% in tax. If you don't use that room, if your income is $70,000, you have another $30,000 of room that you could pay only 22%, because if you put it off, it's going to be higher. And people say, well, I don't have any more income. Well, if you have money trapped in an IRA or 401k, it may behoove you to get it out of there, especially if you're over age 59 and a half, whether you need the money or not. Get the taxes over and done with sooner than later at today's lower tax rates. And while the account values are lower, and then do what? Take the net after tax and put it into something that's tax-free from now on. Now, that's a strategy I call a strategic rollout. And what's tax-free? A L.A.S.E.R fund. And I'll show you what that is here and how you can learn about it. But let's say that a single person makes between $100,000 and $191,000. Well, that's $91,000 of room that you'll pay 24%. If you don't pay taxes at a 24% rate on those IRAs or 401ks, you're going to pay 16.66% more money, right? You're going to pay 28%, which is 16.66% more than you could have paid on money between $100,000 and $191,000. And so that's why I usually counsel people, especially over age 59 and a half, hey, roll some of that money out of an IRA or 401k. I don't care if you need the money or not. Get the taxes over and done with sooner than later, and take the net and put it into a tax-free vehicle. From now on, it'll be tax-free. And you can see an analysis of this. You'll be blown away with how much further ahead you will be. by taking care of taxes at lower rates. Well, let's say you're a married couple filing a joint tax return in the year 2024 compared to 2023, for example. Income, taxable income over 94,000 up to 201,000. That's 106,000 of room. That if you had a taxable income of 150,000, you have another 50,000 that you could pull out of an IRA or 401k and probably pay the lowest tax rate you'll ever pay. Okay, 22%. Between 200,000 and 383,000, that's 182,000 of room that you can pay, probably one of the lowest tax rates you will ever be in the rest of your life. Your current tax bracket is likely the lowest bracket you will ever be in. And money will never be worth more than it is today because of inflation. So this strategy is called a strategic rollout. You're getting the money rolled out strategically, especially if you have room in a lower tax rate, probably the lowest rate you'll ever be in. Get the taxes over and done with. You're not saving tax by putting it off and deferring and procrastinating. You're actually increasing the tax. Did you know that? If you put it off until age 72 or 73 and take RMDs, you'd be shocked how much you'll pay in tax by deferring and then taking RMDs to life expectancy. That's the worst advice for most Americans. I can prove it to you mathematically. Most people that I meet with at retirement, we do strategic rollouts, especially starting at age 59 and a half, and many times we'll get 60, 70% or 100% of their money out of those IRAs or 401ks with the least tax impact possible. And the net goes into something tax-free from now on. Now, you may ask, what's tax-free? Well, that's a property structured max-funded IUL is my favorite vehicle. What is it? It is a vehicle where you're taking the least amount of insurance the IRS will let you get away with and putting in the most money the IRS allows and funding it as fast as they allow with internal revenue code guidelines and tax citations called TEFRA, DEFRA, and TAMRA. You can learn about them in my book or on this channel. When you do that, you'll see that I've been able to earn average returns on a L.A.S.E.R fund. What's a L.A.S.E.R fund? It is a property structured max funded IUL. So a L.A.S.E.R fund is an IUL. But over 99% of IULs in America would not be qualified to be deemed a L.A.S.E.R fund. That's why it's crucial you understand how to structure it correctly so that you can earn an average like I have in the last 5 decades, over 11%, and net cash on cash in excess of 10. I'd rather earn 11 and net 10% internal rate of return, because 10% divided into the rule of 72 will double my money every 7.2 years. I've averaged 9.62% since 1980. That doubles your money every 7.5 years. $500,000 one time. I mean, I've had clients that put $500,000 into their IUL. It doubles to $1 million in 7.5 years, and then to $2 million by the 15th year, $4 million by the 22nd year, and $8 million by the 30th year. It's all tax-free. $8 million generates, $600,000 to $800,000 a year of tax-free growth or income. It's not taxable. It knocks the socks off of traditional IRAs or 401ks. So when people perform a strategic rollout, they get the taxes over and done with sooner than later, and they take the net and put it into a max-funded IUL, so it grows tax-free from now on, and it usually earns a rate of return much greater than maybe their IRAs or 401ks were earning, especially if they were invested in the market. Index Universal Life. Your money's not at risk in the market. You get to benefit when the market goes up because you're linked to an index if you choose, but if the market crashes, you may not make much that year, but you don't lose anything because your money's not in the market. Where people who had money in the market in the Great Recession, they saw $1 million nest egg dwindle down to about 600,000 twice. And it's called the lost decade because in 12 years, they barely had their money back. People who had max-funded IUL, their million doubled and tripled to $2.5, $3 million in that same 12-year period totally tax-free. So if you want to learn more, check out other episodes on this Three-Dimensional Wealth channel. And if you want to read and learn, I would recommend that you study this book. It's been flying off of our warehouse shelves. We send out several thousand of these a month. You can get it on Amazon, the L.A.S.E.R Fund, for $20 to $60. If you do, thank you, but I'll gift you a copy free. All you have to do is go to laserfund.com or click on the link below, and you contribute a nominal amount towards the shipping and handling. I'll cover the rest of that cost, and I'll pay for the book. I'll fire out a hard copy to you via priority mail. And while you're in there claiming your free copy, if you like to listen and learn or watch and learn, there's options for that. You can even schedule an appointment, no cost or obligation, to talk to an IUL specialist that I oversee, I've trained. You want to make sure that if you implement a L.A.S.E.R fund, or more than one, which many people do, that it's done correctly. And there's very few financial advisors that take the time to learn how to do it correctly so that you can earn 11 and net 10. Otherwise, you might be lucky to only earn 7 and net 2. You'll understand more what I'm talking about when you see the example of one done correctly, or you watch some of the episodes on this channel to show you the importance of properly structuring and maximum funding an IUL and maintaining flexibility in the process. So claim your free copy of the L.A.S.E.R Fund book now, and we'll see you on the other side of your brighter future.